In March 2009, a school teacher named Margaret did something her family thought was insane. The stock market had just collapsed 57%. Lehman Brothers was gone. Retirement accounts across America had been cut in half. Every headline was screaming about the worst financial crisis since the Great Depression. And Margaret took the $50,000 she had been saving for a house down payment and put it all into a simple S&P 500 index fund. Her friends thought she had lost her mind. Her family begged her to wait. She didn't wait. That $50,000 is worth approximately $590,000 today. She didn't pick individual stocks. She didn't have insider information. She didn't do anything sophisticated. She simply recognized something that most people around her couldn't see, that the fear in the market had created a moment, a specific kind of moment, the kind that comes along perhaps once or twice in a generation, the kind that where ordinary people who pay attention end up building extraordinary wealth. But here's what I haven't told you yet. What Margaret did in 2009 was remarkable, but the moment we're living through right now, it's bigger, structurally larger, and most people have absolutely no idea it's happening. Hey, I'm Alice from Money Blueprint. Stay with me because what I'm about to walk you through will either change how you think about the next 20 years or confirm something you've been quietly sensing but couldn't name. There's a number at the center of this story, and the number is $124 trillion. Not a typo. $124 trillion is in the process of changing hands right now. Over the next 2 decades, this is the largest transfer of wealth in recorded human history. Nothing comes close. The entire annual economic output of every country on Earth combined doesn't reach this number. It's more than 5 times the current U.S. national debt. It's wealth that was accumulated over 80 years of American economic expansion, and it's about to cascade through the generations. But before you think this is just a story about inheritance, stop, because that's the part most coverage gets wrong. The $124 trillion transfer is not primarily about who inherits money. It's about what happens to an economy when $124 trillion moves. That's a completely different conversation, and it's the conversation that actually determines whether you benefit from this moment or whether it just happens around you while you watch. Let me explain what's actually happening, and then I'll show you the part nobody's talking about. The mechanics start with one generation. Baby boomers, people born between 1946 and 1964, currently control approximately 52% of all wealth in the United States. That's roughly $78 trillion, concentrated in a single generation. The youngest boomers turn 62 this year. The oldest are approaching 80. Over the next 2 decades, this wealth has to go somewhere. Cerulli Associates has mapped exactly where it's going. Generation X stands to inherit approximately $39 trillion over the next 25 years. Millennials will receive approximately $46 trillion. Even Gen Z will begin receiving significant transfers as the wave accelerates through the 2030s and 2040s. Now, here's where most people stop listening because they assume this story isn't about them. They think, I'm not expecting a large inheritance. This doesn't apply to my situation. But that's not the point. That's not actually the opportunity. Because here's what the data shows about how wealth transfers move through an economy, and this is the thing that barely gets covered. When $124 trillion changes hands, it doesn't sit still. It gets invested, it gets spent, it gets deployed into real estate markets, into businesses, into financial assets. Every dollar that moves creates ripple effects, opportunities for people who are positioned to capture some of that movement, whether they receive a direct inheritance or not. After World War II, something comparable happened. Returning soldiers used the GI Bill to buy homes and start businesses. That single wealth creation event produced the baby boomers, the same generation now transferring their accumulated wealth. The ripple effects from one generation's wealth-building event become the foundation of the next. We are watching that cycle repeat at a scale that dwarfs anything that came before. But wait, because here's something even more important hiding inside this story. Most coverage of the great wealth transfer focuses on the dollar amounts moving between generations. But the research from Bank of America and Merrill Lynch found something that almost nobody is talking about. The heirs receiving this wealth have completely different investment priorities than the generation passing it down. 72% of investors between ages 21 and 43 believe it's no longer possible to achieve above-average returns using only traditional stocks and bonds. That's nearly 3/4 of the people who will be receiving $85 trillion in transferred wealth over the next 2 decades. Think about what that means for where the money goes. Baby boomers built their wealth through blue-chip stocks and bonds. Their heirs are showing dramatically stronger preferences for alternative investments, direct company investments, emerging asset classes, and sectors aligned with the technological transformation happening right now. Artificial intelligence infrastructure, clean energy, healthcare innovation. This isn't speculation about future trends. It's already happening. The capital flows are already shifting. The sectors that absorbed boomer wealth for decades will underperform relative to sectors now attracting the capital of younger inheritors. And the companies positioned inside those sectors will see investment inflows that earlier generations never experienced. If you understand this, you have information that most casual investors never consider. But there's still another layer, and this one surprises almost everyone who hears it for the first time. Cerulli's data shows that approximately $54 trillion of the total $124 trillion will first pass to surviving spouses before it transfers to the next generation. Nearly $40 trillion of those spousal transfers will go to widowed women, making women the primary controllers of the largest single wealth transfer event in history. This creates an entirely new market. Financial services, advisory, estate planning, investment management, all of these industries will transform to serve a demographic that previous generations of wealth management largely ignored. The advisors and businesses who recognize this early will capture clients whose relationships will compound for decades. The ones who don't will watch the capital flow past them. Now let's talk about what the people who actually benefited from the post-2009 moment did, because the pattern is instructive. The market crashed in March 2009. Then something extraordinary happened. Not immediately, but over the next 17 years. The S&P 500 rose more than 900%. The index recently crossed 7,000 points for the first time. $100 invested at the bottom became roughly $1,000. And the people who benefited most were not Wall Street traders or hedge fund managers. They were teachers, nurses, accountants, and small business owners who simply kept investing through their 401ks and IRAs while everyone else was panicking. The data tells a remarkable story. In 2010, the United States had approximately 8.4 million millionaire households. By the end of 2024, that number had nearly tripled to almost 24 million. The country added over 15 million new millionaire households in 14 years. That's roughly the entire population of the New York metropolitan area becoming millionaires. And the vast majority weren't entrepreneurs who sold companies. They were regular people who participated in the market's rise through retirement accounts and index funds. According to UBS's 2025 Global Wealth Report, the U.S. added 379,000 new millionaires in 2024 alone, more than 1,000 new millionaires every single day. Most of them built wealth not through dramatic windfalls, but through the steady accumulation of assets in rising markets. But here's the part of that story that almost nobody tells. The people who missed that window, who watched from the sidelines, who waited for things to feel safer, who pulled their money out during the European debt crisis of 2011, or the government shutdown of 2013, or the trade war of 2018, or the pandemic crash of 2020, those people didn't just miss a few percentage points. Goldman Sachs research shows that missing just the 10 best days in the market since 2009 reduced annual returns from approximately 17% to approximately 12%. Missing the 25 best days cut returns nearly in half. The best days, almost without exception, occur during the most volatile periods. When fear is highest, when the headlines are worst, when staying invested feels the most irrational. This is the pattern that repeats, and it will repeat during the wealth transfer period. Because the transfer doesn't mean smooth sailing. Recessions will happen, corrections will come. There will be multiple moments over the next 2 decades where headlines suggest the opportunity is over, where fear creates the same pressure to exit that derailed so many investors in the years after 2009. The underlying force of $124 trillion seeking productive deployment will continue driving opportunity regardless of short-term volatility, but only for the people who are still in the game when the recoveries happen. So what does this actually mean for you in practical terms? The first and most important move is also the most boring one: maximize your tax-advantaged accounts. For 2026, the 401k contribution limit is $23,500, with an additional $7,500 catch-up if you're 50 or older. The IRA limit is $7,000. These accounts allow wealth to compound without annual tax drag, and over the time frame we're talking about, the difference between taxable and tax-advantaged compounding is not a rounding error. It's potentially hundreds of thousands of dollars. The second move is to maintain broad equity exposure through low-cost index funds, not sector bets, not individual stock picks, not the next thing that's going to be massive, the entire market. Because as the wealth transfer flows into various investments, broad market exposure ensures participation in aggregate growth without requiring you to guess which sector captures the most capital. The third move is to understand geography. The wealth transfer will not affect all real estate markets equally. The data already shows this divergence. Markets attracting younger workers and technology investment have dramatically outpaced markets losing population. The same $500,000 deployed in a growing metro versus a declining one will produce fundamentally different outcomes over 20 years. Geographic awareness isn't optional if real estate is part of your strategy. The fourth move is to extend your thinking horizon. The transfer spans 25 years. The people who will look back on this period the same way Margaret looks back on March 2009 are the ones who understood they were not optimizing for the next quarter. They were positioning for a multi-decade event that was already underway. And here's the thing about that. The thing that makes this different from almost every financial opportunity you'll ever encounter. The best time to position for the great wealth transfer was 10 years ago. The second best time is now. Not because the window is closing, because the window is open. The oldest boomers are 79 this year. Transfers are happening in real time, right now, in accounts and estates across this country. Every year you wait is a year of compounding you don't get back. There is no perfect entry point for a 25-year process that's already in progress. There is only in or not in. Margaret didn't know in 2009 that she was capturing a once-in-a-generation moment. She just recognized that fear had created value, and she acted while most people around her were paralyzed. The opportunity today is different in mechanism, but the scale is similar. The wealth transfer is real. The capital is moving. The question, the only question that will matter when you look back on this period 20 years from now, is whether you were positioned to capture any of it. You know the number now, you know the timeline, you know why most people miss these moments and what the ones who don't miss them actually do differently. What you do with that is yours to decide. I'll see you in the next one.